The year was 2008, a year that would go down in history as the epicenter of a financial earthquake, shaking the very foundations of the global economy. The world was in the grip of a severe economic downturn, a storm that originated in the United States housing market and rapidly spread to financial markets worldwide, leaving no sector untouched. In the early 2000s, the stage was set with a rapid surge in housing prices. The cause? Lax lending standards, easy access to credit, and speculative investing. A bubble was forming, inflating house prices beyond their true value, a bubble that was bound to burst. Adding fuel to the fire, banks and financial institutions began to play a dangerous game. They started offering subprime mortgages to borrowers with poor credit histories or low incomes. These initially attractive mortgages often had adjustable interest rates and low initial payments, but they were a ticking time bomb. But the game didn't stop there. Mortgage lenders took these risky subprime mortgages and packaged them into complex financial products. They were called mortgage-backed securities and were sold to investors worldwide. The idea was that spreading the risk would make these securities safe, but they were playing with fire. The financial institutions went a step further. They sold credit default swaps as insurance against default on these mortgage-backed securities. The extent of the risk linked with these derivatives was not fully understood, creating a ticking bomb within the financial system. When housing prices began to decline and interest rates increased, the inevitable happened. Many subprime borrowers defaulted on their mortgages, leading to a wave of foreclosures. The value of mortgage-backed securities plummeted, and investors suffered significant losses. Major financial institutions, including Lehman Brothers, Bear Stearns, and Merrill Lynch, found themselves on the brink of insolvency due to their exposure to these toxic assets. Some declared bankruptcy, others were bailed out by governments, but the damage was done. A domino effect was triggered throughout the global financial system, causing widespread panic and freezing credit markets. The financial crisis didn't stop at the borders of the financial sector. It quickly spread to other areas of the economy, resulting in a severe recession in many countries. Unemployment rates soared, housing markets collapsed, stock markets plunged, and consumer confidence hit rock bottom. Governments around the world had to step in to stabilize financial markets and prevent a complete collapse of the banking system. They implemented various measures, including financial institution bailouts, fiscal stimulus packages, and monetary policy interventions by central banks. The 2008 financial crisis was a harsh reminder of the dangers of lax regulation, excessive risk-taking, unsustainable lending practices, and a failure of financial institutions to accurately assess and manage risks. It was a perfect storm that resulted in one of the most significant economic downturns since the Great Depression, a storm that we are still feeling the effects of today.